Now, for more on the new regulatory realities for banks, plus the European debt crisis and why your money market mutual fund might not be as safe as you believe, we're joined now by Jim Grant. Jim is the founder and editor of Grant's Interest Rate Observer, an independent journal covering the financial markets. He is also the author of the recently published book, Mr. Speaker, The Life and Times of Thomas B. Reed, the man who broke the filibuster. Jim Grant, always a pleasure. Thank you so much for coming in. All right, before we talk about money market mutual funds, I want to bring up the first piece in this week's Grant's Interest Rate Observer. And you've got a quote, really, from Jamie Dimon, the head of J.P. Morgan Chase, who says he doesn't know whether regulators, particularly the Federal Reserve, knows the consequence of the confluence of two things. One is the credit cycle and the regulatory environment. Why did you select that as the lead piece this week?
In part because of the answer he elicited from Ben Bernanke, to whom he addressed this question. And Chairman Bernanke said, we don't know, we really don't have the quantitative tools to wrestle with this question. But a little common sense might prompt one to believe that the accumulation of cyclical and regulatory forces would have a terrifically constricting effect on bank credit. In fact, these regulatory forces are positively asphyxiating. And that's what I think Jamie Dimon was driving at.
Well, and you also used some historical references talking about the Bank of the United States, and said that, by all sort of obvious measures, if you go back to the time before the Depression, many banks looked on paper as if they were complying with great regulatory capital rules.
The great hot-button issue, as we heard a moment ago, is, of course, bank capital. That is what the investors, the stockholders in a bank, actually own, as opposed to what the depositors have lent the bank. And this capital is maybe 8, 9, 10%, depending on the bank, maybe sometimes more, sometimes less. The regulators want more, especially for banks that, like Jamie Dimon's, are deemed too big to fail. Okay, that's the idea. What I contend is that the trouble is not a lack of capital, it's a lack of capitalism. The federal apparatus has become positively asphyxiating. It is sucking the oxygen, the life, and the enterprise out of these banks. To be sure, these banks did not deport themselves with terrific splendor during our time of sorrows in the late 2000s, 2008 and 9 especially. But the answer is not exactly what is prescribed.
Jim Grant, you were speaking rather, about the effect of capital requirements on banks, saying that it isn't more capital that we need. What we need is capitalism. Explain what you mean.
Well, we need enterprise, and we need owners who own and who bear not only the upside, but also suffer the downside. Now, what the regulators want is a box-ticking mechanistic rule that will, they say, prevent the next cataclysm and certainly prevent fingers being pointed at them, the regulators. So they are prescribing much more capital for these banks. It is a wholly cosmetic and unhelpful proposal. To give you an example of from yesteryear, the crystallizing first fatal bank failure in the Great Depression in this country, 1930, Bank of the United States. It was the bank that toppled first and not last, but first. And however, if you go back and look at it, Bank of the United States had 17.7% seeming hard capital to assets. 17.7%. It was pretty good. The assets, however, were slow. They were real estate assets. So what is wanted for good banking is good bankers. Bankers that recognize the difference between illiquid assets and liquid ones, that can underwrite properly. In other words, that can engage in an activity that is separate and distinct from running the government of the United States. As it is, they have the Congress of the United States telling them exactly what to do, and it's not working.
Well, and you do mention in the story, and I recommend it because you talk about the 2 apartment houses in New York City.
Well, the Bank of the United States was the underwriter for some of the greatest...
The San Remo apartment house on the west side of Manhattan.
Central Park West.
The Beresford.
If you look west from Central Park, you will see these spectacular buildings. And so the quality of the assets the Bank of the United States underwrote was nothing but top-notch. However, one could not sell them when one had to, especially not after the stock market broke. So, amen. Liquidity will get you a lot more than some federally mandated capital guideline.
Well, I have to mention also that, from your prolific pen, not in addition to Mr. Speaker, the current book that you have out, The Trouble with Prosperity, also chronicles the illiquid quality of certain real estate investments.
Real estate is inherently and forever illiquid, and it was actually prescribed to the national banks under the first National Banking Act. Only recently has real estate come into the mainstream of banking acceptability, and even for some of us, it really never has come in.
into the mainstream. All right, well done. All right, let's shift a little bit because I want to turn everyone's attention to another topic that you've been focused on, and this is money market mutual funds, which I would dare say for most investors, when you utter those words, they think rock solid, guaranteed. That's the same as cash.
One would so suppose. And indeed, first of all, let me preface this by saying one so sympathizes with people try to squeeze the blood from these rocks of zero interest rates. The prime portion of the money market mutual fund business is about $1.6 trillion. It's very big. The Fed has suppressed the funds rate to zero. It falls to the managers, the hapless managers of these funds, to try to find some yield somewhere. Now, American banks basically have no need of new funds. They have been topped up by the Fed. So what do? They go abroad. They go to Europe looking for bank commercial paper, certificates of deposit, and what have you, short-dated instruments from the best of the European banks. Well, maybe the best of the European banks aren't so good. It might just be that they are overexposed to sovereign risk on the continent of Europe. Indeed, I think it's a fair surmise.
And let's just run. I want to run some of the charts that we put together using the statistics that you provided, having to do with the largest money market mutual funds, showing that many of their holdings, in some cases the majority, not of the whole holding, but of the majority in terms of the largest number, are European, either commercial paper or some other type of short-term
bank
obligations. And that's prescribed by U.S. regulators because of the debacle that we went through previously with money market mutual funds.
The unintended consequence of this zero interest rate campaign is to drive these funds, these investors, abroad in search for something resembling a yield. By the way, they're not finding it. Most of these funds yield 1, 2, 3, 4 basis points. I mean, you know how long it takes to double your money at 1 basis point? 1/100%. 6,900 years.
I dare say we won't be around for that.
You have to be so patient.
Well, all right. Just as someone who's not just pointing a finger, but you recommend an alternative. You say, maybe not.
Yeah, I mean, you can find something resembling a normalized yield. You have to take some risk and credit.
Corporate.
You can get a short-dated corporate bond fund for like 3%, which is only a little below the rate of inflation. Or you can go to a government-only money market mutual fund that pays you nothing but entails no European risk. I mean, the world is a place of sin and sorrow. There's always risk. There's always something to be worried about. We humans, always apprehensive, sometimes for good reasons. The problem is not the prevalence of risk. That's the nature of getting up out of bed in the morning. The trouble is the zero upside for this risk. You're getting paid, in the case of the biggest money fund, the Fidelity Fund, you're getting paid 1 basis point a year. A single lonesome basis point.
For taking this risk.
Not inconsiderable risk. And thank you, Federal Reserve, for giving us the stimulus to face this problem.
Well, there's also another knock-on effect, which is that if you decide, okay, this risk is not for me, how about 3-month U.S. Treasury bills? And you've done some work that shows that
very
they're
little
just
work is required.
Right, but you've done it, and you've noted that there are not enough Treasury bills out there to supplant all of this debt.
Okay, the prime money fund business has about $1.6 trillion in assets under management. These are commercial paper and the like. The population of marketable Treasury bills numbers a little bit more than $1.5 trillion. So if all of a sudden everyone wants a Treasury bill, there are not enough to go around.
Jim, sovereign debt, that has certainly been in the headlines. It's not necessarily sovereign anymore, at least when you take a look at what the credit rating agencies say about it. What's your thought for Greek debt, European debt, and the seemingly rock and a hard place that everyone has fallen into?
People, I think, reflexively regard the obligations of sovereign governments as a port in a storm. Governments famously said, one of our own New York City bankers a generation ago, don't default. Well, that actually as untrue as he himself came to see. But even today, after so much difficulty in the sovereign credit markets, whether it be Greece or elsewhere in Europe or elsewhere in South America, people, I think, still latch on to these bonds as if they were inherently good. For example, in the case of the United Kingdom, British gilts, as they are known, sovereign obligations of Her Majesty's government, are priced to yield, each and every one of them, up until 30 years, less than the ruling 4.5% year-over-year British inflation rate.
Inflation, right.
The CPI in Britain is 4.5% year-over-year. Gilt yields 3-something, high threes, up into 30 years, 4-something. In any case, less than 4.5. So you are losing money on gilts up to 30 years. Now, there was not so many years ago an idea that the bond market vigilantes would rise up as one angry creditor and smite that government that in its insolence would undertake to inflate the currency and thereby to steal from the very pockets of the creditors. This was in the wake of a 35-year bear bond market that ended in 1981. In the 80s and 90s, this idea took root that creditors would never again suffer the outright theft, let alone the public humiliation of being fleeced by these bureaucrats and politicians. Well, it's happening. We do forget. And I guess that people regard these obligations as better than nothing and as better than other assets, although I can't for the life of me think of many assets that are less appealing.
I do know, and in that regard, I do know that you've written of a comparison between various governments and various corporate entities, making the point that there are corporate entities that continue to invest in their future, that continue to grow their operations. And the question then for the investor is, would you rather be lending your money to an entity that is growing, that has a strategic vision, that will pay its debts, versus one that is based more on hope and political fealty?
Or to jump out of one asset class to another, what would you rather own? The sovereign obligation of some government that is cash flow negative, or, for example, the equity of Walmart that is priced at a pretty high multiple of free cash flow. A rather appealing low multiple price to low free cash flow that is yielding something, I'm going to guess 2.3, 2.4% in the case of Walmart.
But then you get the possibility of capital appreciation with the equity.
That is buying in shares, that is first and foremost adaptive, and that is on your side. That means that the thing about corporate enterprise with respect to the stockholders is that you all have the same interest. You want the shares to appreciate. With respect to debt, and particularly sovereign debt, you wonder if you are not playing against the house. There is no central bank I know of, no major central bank, that is operating as if it wanted its currency to appreciate. On the contrary, most central banks are very happy to see depreciation. So you are owning the promise to pay of a government that is sponsoring a central bank that wants the currency, in which it will pay you, if it does, to get cheaper.
That's right. They want to devalue those debts. Last question for you, gold. You still like to buy gold at this level?
I do. I confess to a certain amount of sticker shock. And of course, one can't value gold as one could the common equity of a Johnson & Johnson or Walmart. But I believe that the price of gold is the reciprocal of the world's faith in the likes of our modern central bank management. And as the faith recedes, as I think it ought, the price of gold perhaps might go up.
I want to thank you very much. As always, a pleasure.
You're welcome, Pimm.
Very insightful. Thank you. Jim Grant, Grant's Interest Rate Observer.